All right, welcome back, everyone. It was a busy December this year as the Secure Act 2.0 was passed. The government has made it clear, do not rely on Social Security. The Secure Act makes a lot of changes to retirement plans, and essentially the goal is to incentivize Americans to save more in their retirement accounts so they aren't hung out to dry when they're ready to retire. So I want to run through a lot of quick changes. I'm not going to talk about the specifics of some of these plans because I've got other videos if you're more interested in how they work. So let's go through it. The first change is the automatic enrollment for 401k plans. This means that employers will automatically enroll employees in their 401k plans if they have them. This is different from before because employees had to opt into the plans. Now they will have to intentionally opt out. The automatic enrollment amount is 3% of their salary. There's a maximum initial enrollment of 10%. And this will increase each year automatically by 1%, but it's capped at 15%. So this is obviously forcing employees to save more for retirement unless they intentionally opt out. Of course, current 401k plans are grandfathered in and do not fall under this new automatic enrollment. There is an exception for small businesses. So if you have 10 or less employees, this automatic enrollment does not apply to your plan. And this starts for plan years, so retirement plan years that begin after December 31st, 2024. So we've got a couple years before this goes into effect. The next important change, and this is a big one, this can be important if you want to set up a retirement plan for your employees. This is the credit for small employer pension plans. So it's a startup credit. Now, this has been around, but it has been modified. Previously, if you started a plan, you got a credit for 50% of your costs for starting up that 401k plan with a cap of $5,000. Now, it's for 100% of your costs up to $5,000. So this potentially could actually cover almost all of your costs of setting up that plan. This applies to employers with up to 50 employees. So this is for small employers. Additionally, they've added another credit related to these new plans, and that is a credit of up to $1,000 per employee for amounts that the employer contributes to the plan on their behalf. And that is 100% for the first year. 100% of those amounts contributed up to $1,000 per employee. The percentage of the credit is 100% for year 1 and 2 for those amounts that the employer contributes on behalf of the employee. And then it starts to phase down so that in year 3, it's 75%. In year 4, it's 50%. And year 5, it's 25%. And then there's no longer a credit after that. Again, that is for employers with 50 or less employees. And that additional $1,000 credit that you can get starts to phase out between 51 employees and 100 employees. And then it would be gone. This credit is actually available for plans starting now in 2023. This is something you can start to do immediately to start providing incentives for employees to save and be subsidized to contribute to their plans. The next change relates to simple IRAs and SEP IRAs. And if you want to know the difference, again, reference the other videos where I'll talk about the specifics of each of those plans. But generally, this is for smaller employers, and they're very similar to 401ks, but they have different limits than a 401k, and they're generally easier to set up. And the change is previously, you had to have these set up as a traditional type IRA, which means that when you make contributions to it, it's tax deductible at that time. And then when you take the money out of the retirement plan, then it's taxable. Well, you can now do these as a Roth contribution, which is the opposite. That means when you contribute to the plan, it's still taxable. So it's not a deduction, but later when you withdraw those funds in retirement, it is no longer taxable. And this can actually be a great strategy now that we're heading into potentially a recession, or some think we're already in a recession, because if you have lower income, it may be better to sock away money that's being taxed now at a lower rate and then take it out tax-free later when maybe you're at a higher rate. The other consideration is if you're younger, sometimes Roth retirement accounts can be a better alternative because you have money that is growing in there tax-free that won't be taxed for a longer period versus a traditional, when it's growing for a longer period, well, it's going to grow more, but it's going to be taxed at the end. Okay, so that's another reason. If you're younger, Roth retirement accounts can make sense. This change is actually effective for next year, so plans that start after December 31st, 2023. The next change is actually related to the savers match. And this one, a lot of people don't know about, but this can be a really great credit for people that are just starting out at a new job. So maybe they've just graduated college, and so they worked a partial year because they graduated in May. Maybe they started in August, so they only have 4 or 5 months of earnings. So they've earned less. So for the year, their taxable income is low. But if they were contributing to a retirement account, you can actually get a credit. So it's 50% of your contributions up to $2,000. And this is for contributions to an IRA or other retirement plan. So this can really help subsidize. The change is that previously you would claim this credit as a refund on your taxes at the end of the year. Now it actually has to be a contribution to the plan. So again, the government is saying you need to save more. So they're changing the credit from being a refund that you could do whatever you wanted with to being a contribution to the retirement plan. Now, like I said, this is for lower income individuals. So it starts to phase out. In other words, the dollar amount that you receive as a credit phases out. For single filers, $20,500 through $35,500. And above that, you're not getting a credit. For married filing joint, it phases out between $41,000 up to $71,000. And beyond that, you're not getting a credit. So again, this is for lower income, or if you have a partial year of income, then this can be a great way to subsidize your retirement. The change in this credit is not effective until December 31st, 2026. Okay, we're almost there through the changes that are really important from the Secure Act 2.0. The next one is the change in the required minimum distribution. So this means when you reach a certain age, currently 72, you are required to start withdrawing funds out of certain retirement accounts. The purpose of this is because the IRS is saying that they don't want you to defer the taxes on that forever. There's a minimum age, 59 and a half, and then there's a maximum age where you start getting penalized if you don't take a minimum amount. And the change is that it's going to increase from 72 to age 73 this year, January 1st, 2023. And then it will increase again to 75 in the year 2033. The last change relates to catch-up contributions for those 50 and older. So currently, those that are above 50 can contribute an additional $1,000 to their retirement plans, and this amount will now be indexed for inflation starting after 2025. Plus, the catch-up contribution for those 60 to 63 specifically, those people are allowed to contribute up to $10,000 potentially instead of $1,000. So that's a pretty big difference. The additional $10,000 catch-up contribution for those aged 60 to 63 will begin after December 31st, 2024. Okay, guys, I know I ran through that quickly and there were a lot of changes there. There were actually a lot more, but these are the most important ones that I think will affect most taxpayers. So hopefully you found something useful, and I'll see you in the next video.